All right, so today we are so excited to have Frank Iannelli and Chris O'Shell joining us from Whitley Penn, who's another one of our sponsorship partners. Frank is the Strategic Consulting Services Managing Director, and Chris is the Strategic Consulting Manager. Chris has spent 7 years in the firm's valuation and M&A group. Together, their team provides, along with other people, they provide strategic consulting services to companies, management teams, and boards of directors. They consult on many different subjects, including profit improvement strategies, financial forecasting, CFO services, turnaround restructuring, and transaction consulting. So today they're here to talk about valuations, mergers, and acquisitions through the scope of some really good storytelling. So without further ado, Chris and Frank, I'll let you take it from here.
Great. Thank you so much, Devin. Chris and I really appreciate the opportunity to present today. It's good to see some old friends and meet some new friends, and I've worked with several of you in the past. As a little background, Whitley Penn is a full-service CPA firm with over 600 professionals. We're Texas-based. We have offices in Dallas, Fort Worth, Plano, Houston, Austin, and we just acquired a firm in West Texas. We provide the traditional audit, tax services, but we really pride ourselves on the consulting side, where we have a pretty robust valuation group, litigation support, strategic consulting, a wealth group, and others, which is a way we could add value to our clients. And so with that, I joined the firm in December to start this new group, and we work with a lot of clients on buy-sell side valuation. And previously, I was the CFO, CEO of various companies in various stages of the life cycle, from startup to private equity portfolio companies. And with that, Chris, why don't you kind of add to your background?
Yeah, so thanks again, Devin, for the intro. Been with Whitley Penn now for going on 7 years, and spent most of that time doing valuations of companies in a variety of industries. I've touched most industries, and from sizes ranging from pre-revenue to $1 billion in revenue. I've worked on the buy and the sell side of transactions, done quite a bit of litigation consulting. So if you need help with how to avoid the trenches, got that covered. And so now I've been with Frank for about 8 months, helping companies improve profitability.
Great. So what we want to walk through today is kind of an overview of why valuations are necessary, define the various valuation methods, how to perform a valuation, and really I think the questions that are popping up is, what's the difference between valuing a startup than a traditional company? And we'll walk through various scenarios and maybe tell a few stories in the process.
Awesome. So let's first tackle why we might need a valuation, what situations would arise. So when we think about startups, really what defines them, what makes them different from a stabilized business or a business that's not a startup, that's profitable, is that they're high growth. And so since you're starting from zero, your growth is naturally going to be high. And the other thing that defines them is a lot of times they're going to be pre-earnings, and sometimes, depending on your life cycle stage, you're pre-revenue. And so when we think about growth, there's always going to be something, a need for funding. And so sometimes that comes in the form of sweat equity, where the founder is able to invest their time, and that's really the main funding source. But as time goes on, there'll be needs for capital funding of some sort to grow and expand and take the business to the next level. And so when we think about needing capital to fund growth, there's two sources of capital that we can access in business in general. The first is debt, and the second is equity. And so debt is the simple one. It's just like a mortgage on your house. If you take a loan out, you're going to owe back principal and interest on some sort of set schedule. And the bank's going to require that you pay that back regardless of your level of income. You're on the hook for it. Equity is different in that we're actually selling a stake of our business, and the benefit of equity is we're not required to repay if we're not generating profits. And so because oftentimes startups aren't generating profits, and we like to say ideas don't pay interest, equity is the only source of capital available to startup companies. So anytime there's going to be a transaction of equity, and that's what raising equity capital is, it's selling a piece of your company, valuation becomes an issue. So it sounds like a lot of you guys are maybe in talks right now for one of those transactions. So hopefully this is helpful to kind of explain how valuation works.
Yeah, thanks, Chris. So this slide has a lot of words and numbers, and that's something for you to read later. But the point we want to make here is, I would assume most of you have seen Shark Tank, and when an entrepreneur gets into the tank, the various questions that the investors ask. And this is a situation where you have an entrepreneur who has a software product, and he requires $128,000 to finish this product. And when asked, how much equity would you want to give up to that, he struggles. And so the correlation between value of the company relative to what you're raising becomes an issue. And Chris kind of wants you to walk through that.
Yeah, so something we see a lot, and I think this is partly tied to the emotion attached to this thing that you've created that's yours, right? Is that an entrepreneur will come in and say, well, I know how much money I need, and I know what I need it for, and I know what percentage I'm willing to give up. And so the conversation goes something like this: well, how much money are you raising? And I'm raising $128,000. Okay, for what percent? And then they say, for 10%, right? Because that's what I'm willing to, that's all I really want to part with. When you've done that, you've implied a value for your company. And if you've watched Shark Tank, you've seen this happen a million times. Is, well, so your company's worth $1.2 million. How did you come up with that value? And so what we would propose is that the right way to go about this is to first come up with the value, and then you know how much you need, and that's going to determine what percentage interest you're going to transact. And so this is real basic, but what is valuation? It's an estimation of worth for an asset. And so the word estimation there is really important, because you could have a number of different people who are competent value an asset, and they may come up to a different value. And so part of this has to do with what's the story that they're telling in their valuation. And we'll get to that later, why that's so important. Another point I'd like to make is that valuation and price are not the same thing. And so I just listening to you guys' backgrounds, it sounds like this is a pretty important concept to grasp, because price, we all understand. Price is what you and I agree to transact at. It's the same for both of us. It's what I give up, and it's what the other person receives. Value is not necessarily the same for both parties. So I could conceivably have a product that I've developed, and it's a business now that I've created around it that's not profitable. So to me today, it doesn't have any monetary value because it's not generating cash flows, but to somebody else, it might have value today. They might have a portfolio that they could layer it into. And so when you're thinking about raising capital or selling your company, it's important to think about the fact that value for you may not be the value that your seller or your buyer could realize. And so I'm going to give a quick high-level talk through the valuation methods. The first two I'm going to kind of fly through, and then the last one I really want to key in on. So there's three methods of valuation. These are the only, or three approaches rather, to valuation. These are the only three approaches. Within each approach, there's various methods, but I'm going to kind of hit on the most standard ones that are used. So the first approach to valuation is the asset approach, and it's very simple, and it's probably not all that applicable to a startup company, but it's useful to us nonetheless. The asset approach goes down a balance sheet of a company, and looks at the assets it holds and the liabilities it owes and adjusts each of those to a market value. So this is a market value as if we were going to go sell off this asset. And so what we did there on the right is we adjusted all these assets to market value, and then we assume that we pay off our liabilities, and what's left over is the value of the company under this approach. The reason this isn't very applicable to a startup company is because I can't look at a balance sheet and see how good your technology is. I can't see the customer relationships you've developed. I can't see the marketing and branding that you have. It's not on a balance sheet. And so the asset approach is really going to be utilized as a floor value for the company. And so I think it's useful in that we know if we're valuing our company, it can't be worth less than we could go sell the individual assets at. So it starts to kind of narrow down the range. So the next approach, and this one you'll probably be more familiar with, is the market approach. And so the market approach, we're going to go find companies that we view as similar to ours, either public or private, that have transacted. And we're going to use those transaction values to come up with multiples. So all a multiple is the value of the company divided by some sort of operating metric. It could be a revenue metric. It could be an EBITDA metric. You know, in tech startups, it could just be users. So we could put on a value per user basis. That's all a multiple is. And so the reason we come up with a multiple is so we can apply it to one of our company's metrics. And so here you see there's a group of public companies. We've designated them as similar to our company. And so we've come up with revenue and EBITDA multiples based on their value and their operating metrics. And then we're able to apply that to our company's revenue and EBITDA. The next slide, you'll see the same thing. So those were public companies. We know we can go pull those stock prices and figure out those multiples. Here is some private companies. This is something that you may or may not have access to. There are paid subscriptions and databases out there that house details of private company transactions. Those can be very useful for you if your company is generating revenue or EBITDA. But it's very important that you find comparable companies. You may go on a search and find that there's only one comparable company that's ever transacted, and that may be your only data point for this approach.
Yeah, Chris, to that point, what we often hear is a client or prospect coming in and saying, we'd like to sell our business, and we think we should get a 15 times multiple because that's what my neighbor got. And then we would ask, what does your neighbor do? Well, I don't know, but I want his multiple. And so his neighbor may have a technology company and his business may be a capital intensive company, maybe losing money, the other one making money. So we often hear people say, I want the multiple the other guy has or received, but they don't understand where it came from. So it's real important for the multiples to be of a similar type company in a similar type industry. That's how the investor would look at it.
Absolutely. And so the last approach, and this is the one I want to spend the most time on, is the income approach. And so when we think about valuation in any of the approaches, it's always going to be based on future cash flows. And so I don't care if you're Tesla and you were negative earnings for however many years they were negative earnings, they were trading on the stock exchange at a value of billions of dollars with no earnings, right? So there was no cash flow there, but that valuation was based on the investors, the buyers of the stock, their guess about the future profitability and the future cash flow of that company. And so really, whether we're a startup that has no profits today and won't for a long time, or whether we're an operating company, it doesn't really much matter. Valuation is always going to be based on some expectation about future cash flows. And so the things that matter when we're looking at future cash flows are how much cash flow am I going to expect? When am I going to expect it? And how risky are those first two assumptions? You know, how is my estimate risky to attain? Is my timing risky to obtain? These are the assessments that an investor is going to be making. And so the first and probably the most difficult to get your head around is the risk factor. So timing and amount are can be relatively easy to estimate. The risk factor can be a little bit harder. And so that's what a discount rate does. So a discount rate is an interest rate that's used in the discounted cash flow method to bring future cash flows back to present value. And a helpful way to think about the discount rate is that it is the required rate of a return that an investor would require on an investment to put the money in. So the riskier the investment, the riskier the business, the higher the rate of return an investor would want to receive in order to make that investment. And so over here on the right, there's this rate of return chart that I put together, and it's from 2019. So the Treasury rate there of 1.92%, it's probably like 0.5% today. So that's changed a little bit, but the basic concept holds. The less risky the asset, the lower rate of return we require to put our money in it. So Treasury bonds are generally viewed as the least risky asset. We even go so far as to call them risk-free, even though they're not truly risk-free, they're the least risky thing. And so this chart walks all the way up to venture capital funding round rates of return. So seed funding being the highest. And the big concept to remember here is that the higher the discount rate that we apply, the higher the risk that we apply to the company, the lower the present value of those cash flows is going to be. And conversely, the lower the discount rate we apply, the higher the present value of those cash flows. And so here's a cash flow forecast shown for an operating company that has revenue and has cash flow. And so in 2020, we'll call that the current year, they made $5 million in revenue. They netted $440,000 in cash flow after reinvestment. And so we use those historical numbers, and the company's made some estimates about what it thinks it can do to grow revenue over the next 8 years. And they've walked that down to cash flow, and then they're applying a discount rate. So, you know, that 30% discount rate, that's not low. It's not a low discount rate. That reflects a pretty high level of risk if we were comparing it to that chart. But you can see down there the future value of the cash flows, and then we sum those all up, and we've got the sum of all those cash flows, and then we add in the terminal value. So the terminal value is really important. You can see it makes up about a fourth or fifth of the overall value. That terminal value is everything from 2028 into perpetuity. So when we look at a startup company forecast later, you'll see a lot of the value shifts into that terminal value. And that's because, you know, generally startups are going to have a lot of value baked into the back end when they become profitable.
Yeah, so one main point here is the last line shows if you change the discount rate from 30% to 20%, the value of the company increases from 4.9 million to 8.6 million. And that's the cause and effect of the discount rate. And some of the things that impact that discount rate is how certain or predictable are your future revenues and profits. So for example, in these revenue projections, if they were tied to contracts already established or guaranteed contracts or things that provide certainty, an investor would require a lower discount rate. If they're just kind of pie in the sky, then they're going to not have as much confidence in those. And so typically when preparing projections, it's real important to do what we call a bottoms up approach, where you start with how big the market is and how much of a market share you think you're going to capture and so forth. The more information, the more buildup, the more information an investor can digest and then challenge some of your assumptions.
Great. And so here, this slide, you know, if you were able to apply multiple approaches, you would do something like this. You would have a value for the asset approach, the market approach, public companies, private companies, and then the income approach. And you would kind of go down and you'd say, hey, the asset approach, really, that's not applicable for our company because there's all sorts of assets that we possess that aren't on a balance sheet. So we never see that using that approach. Maybe public companies, they're so much larger than us, more established distribution networks. And so really we can't look at those multiples because they're just so much less risky than we are as a business. And so here we've kind of said, you know, the private company approach and then the income approach were applicable. So that's how you would triangulate a value if you could use multiple approaches. So that was an operating company. And the reason we went through that is the conceptual underpinnings of valuing a startup or something that's pre-revenue or pre-earnings is really no different than valuing a company with predictable cash flows. We have to perform all the same mechanics, but there are a few things that are different and that you're going to have to kind of wade through as you try and value your company. So the few things that are different: first, earnings multiples. So those EBITDA multiples we talked about are probably going to take a back seat. If you don't have earnings, you can't really apply an earnings multiple. The next thing is the assumptions are going to become harder to nail down. So when we've got a company that's generating predictable revenue and earnings, it's fairly easy to put together a forecast because we can look at our history as a basis for what may happen in the future. If we don't have that, it's going to get a little bit harder. The next thing is discount rates go up. The younger your company is, generally the riskier it's going to be. And then last and most importantly, the story takes center stage. And so quickly, I want to spend a few minutes on this slide and talk about one of a few ways that you might build up a forecast for a company that doesn't have any revenue. So you can see here now in 2020, our company has no revenue and no earnings. So all we have is an idea. And so what we did here, and this is what I would do, this is where I would start if I was trying to value my company, and many of you may have done this. So you go out and you figure out how big is the total addressable market for the product or service that I want to provide. So here we're saying today it's $1 billion market. And then I would go out and I would say, okay, who are the major market participants in this space and what's their market share? So here we've got software company A, B, C, and D there at the top, and they make up 83% of the total market share. And then there's some more fragmented participants that make up the remainder. And then if the data is available to you, and it will be if they're public companies, I'd go figure out what their pre-tax operating margin is. And I would use this as a way to determine what sort of margins I should expect to see once I become profitable. And so that's what we've done here. And we've taken this total addressable market and we've made an estimation of what percentage of the market we think we should capture. And so Frank will get to this in a second when we talk about the story, but you can't just pull that number out of the air. It's got to be based on something. And so we're saying here that over the next 8 years, we think we can capture 3.5% of the total market. And so that translates into a revenue number for us. And so that's really the starting point for our projections. And so from there, We can use market data and just a good old spreadsheet and figuring out what it costs to make our product, sell our product, market our product, and all those things to forecast out margins. And so here you can see our forecast. We go from being unprofitable after reinvestment till 2026, and we finally reach a revenue level that allows us to be profitable. And then by the end of our forecast, we've hit industry margins and we're at a stabilized point. And so jumping down to the bottom here, you'll see that terminal value has all the value for our company in it. And that's because when we look at this discrete period here of 8 years, there's just so many negative cash flows on the earlier side of our forecast. So the further out the cash flow is, the less valuable it is. And the closer it is, the more valuable it is, because we're not discounting it by as many years. And so all our value ends up getting baked into what this company can do after it's reached significant profitability.
So a lot of what we talked about so far has been pretty mechanical. There's a formula, there's a certain way to derive at the numbers and so forth. But more importantly, I think, is the story behind the numbers. How do you romance the numbers to get an investor's attention and for them wanting to pursue it? And so we see that those that are prepared and have a well thought out document, memorandum that answers the questions that we know, that the investors will ask, have a higher success rate, in that the investors have a short time frame, short attention span, and they're presented thousands of deals throughout the year, and they have to decide which ones they should pursue and which ones that it's not worth their time, or it will take them way too much time to spend on this. And so we spend a lot of time on the story. How do you romance it? And again, if you guys have seen Shark Tank, it's the same questions that they get to even before they talk about the company, because at the end of the day, they're investing their money with you. It's a people business, and they're trusting you with their money to execute your strategy. You can have a great product, you could have a great strategy, but if you lack credibility or they don't believe you're a good steward of their capital, they'll go elsewhere. So being prepared, and here's just a few of the basic questions that should go into a memorandum or a teaser or a document, really describing what your background is, what made you excited about inventing or creating this product, what purpose does this product serve, what are you trying to solve, how much money have you previously raised, and where did that money go? Was it a good decision, bad decision? How much of your own capital have you invested? Investors always like to see that you have skin in the game. What makes your product or service unique? Do you have a patent, proprietary technology, information? Who are your competitors? Why are you doing it better? And so those qualitative things that go into a document really describe where the success will be, and then the valuation will support it. I think having one without the other doesn't really get you there. I think they have to work in tandem. I often see people spend less time on the story, and then when the investors start asking questions, they stumble and aren't prepared. And again, you're competing with many other entrepreneurs for their capital. Investors have a short attention span. They'll go elsewhere unless you have something truly unique. And most importantly, they want to know when they're going to get their money back. And then as a result of that, they'll determine what discount rate to apply to the opportunity.
Yeah.
And so we see it. There's a lot of capital out there chasing good opportunities. We don't see a lot of capital chasing bad opportunities.
Yeah, absolutely. So when we think about marrying the story to the valuation, you may want to show a forecast, and you likely will when you sit down and talk to an investor. But I think that every number that you show should be tied into the story. If somebody pointed to a number on that page you should be able to explain, well, this is exactly where that fits into the story. Yeah, that's year 3. Here's where I'm going to be in year 3. Here's why expenses are going to drop in year 3. You got to have, all of it's got to be married together.
Right. And so to recap, we want to make sure we have enough time for questions. You know, we talked about valuations. At current time, you need to raise capital. That's the mechanical tool that's needed. The valuations are based on expectations of future cash flow and the assumptions regarding that. A startup company requires more assumptions and rely on cash flow projects. And the story, as I said, is just as important as the numbers. So romance it. Tell your story and be passionate about it.
Thanks. Well, yeah, now I think what maybe hopefully is the most helpful part of this is we can answer any questions that everybody has. So.
Wonderful. Well, thank you guys so much. First off, round of applause. Really appreciate that. There's a ton of questions that people have. So it'd be great if maybe 30 to 40 seconds per each question for some of the longer ones, but we will start. And then I've gotten a lot of chats privately and publicly for questions. So if I skip by your question, feel free to just remind me of it and post it in the chat again. But first off, let's start with, all right. We had a question that said, how did you calculate the bottom line? But I believe you showed that in one of your slides, correct?
So the actual mechanics of the discounting. So there's a number of ways you can do it. You can use the present value formula in Excel, or you can, if you go to Investopedia and you just type in discounted cash flow, it'll pop up the formula to use to discount each of those cash flows.
Perfect. Okay, next question was from Jeff. He said, how long is a period used for terminal value calculation?
So you can perform a terminal value calculation at any period in the projection. So terminal value calculation is going to want to know how many years out I'm starting that calculation, but you calculate the terminal value by capitalizing the cash flow, and then you present value it by how many years out it is. So you can do the terminal value at any point.
Typically, you see it in established companies in year 5.
Year 5. Wonderful. Next question was from Allison. And she said, are you using Pitchbook to calculate the market share and do the SWOT analysis of the companies within the same market?
So we've got a number of different resources that our firm uses. One of them is Capital IQ. We use that. I'm familiar with Pitchbook. I've not used it. There's also tons of just publicly available resources out there. If you just start Googling, I don't think a lot of the times you have to necessarily pay for a subscription. But if you find that you can't find something, reaching out to a friend that's somewhere where they may have access to that information can be a useful resource.
Wonderful. Next up is Ranjan. He asks, how does sweat equity get calculated in your models for a founder's cash and sweat equity are invested in the company? Yeah, for a founder, their cash and sweat equity are invested in the company. So how do you calculate that?
So really the value of their sweat equity should make its way into the cash flows, right? So it's a component of those future cash flows. You could look at, in lieu of using a cash flow projection for valuation, you could look at how much capital has been invested into this business up to this point. So one way to do this would be to say, okay, how many hours have I put into it? What's my time worth? That's my sweat equity. But if we're doing a cash flow based valuation, sweat equity is going to be reflected in how much cash we can generate. So it'll tell us whether our sweat equity was worth it or not.
Wonderful. All right. The next question was from Jeff, and he said, how do you factor IP into evaluation, or does it get factored?
So yeah, it's a little bit of the same, answer. So we know that we can go turn around and sell intellectual property that's not necessarily valuable in our hands to somebody who might be able to do something with it. For an example, maybe it's medical device company. You've developed a valuable product, and you maybe don't have the distribution channels to realize all the value from it. But maybe if you sold it to Medtronic or Stryker or one of the big guys, they'd be able to push it out. So it may be really valuable to them. So that kind of gets to where there's different value in different people's hands. But I would come back to say the way you value intellectual property is the same as how you value a business, in that it's as valuable as the cash flows it can generate.
Wonderful. Okay, next up from Marianne Block. And she was wondering, does the same approach work for selling a business as it does in raising money for a business?
Yeah, so the approach is exactly the same.
Mm-hmm.
Yeah. So the one difference being, if I'm raising capital to grow a business, I'm going to remain in control. So the value in my hands is what we're calculating. If I'm valuing a company to sell it, I may want to look at what the value would be in somebody else's hands, which could be more or less potentially.
Wonderful. And then Allison had another question. So a VC group reached out to them, and we have a couple different founders in the room that have started reaching out to VCs. So I guess in general, when going into a meeting with a VC or with somebody looking to do this, what should you expect going into that meeting? Do you have any words of wisdom for that?
So I think when meeting with an investor or VC is being prepared. I think along the lines of the comments on the story, they want to get to know you as a person. They want to know why you created or invented this product, what's your passion, what's your background, what successes have you had, and then from there it's a buildup of where you think the business can go with the additional capital, what you use the capital for. So I think being prepared and being passionate for what you do, and being realistic as well as far as what value you're seeking. So for example, when the first meeting, say I want $1 million for X, is you kind of build up to it. Let me tell you about my product, my background, and what we're doing, and then the punchline is, this is what I want to raise and what I want to use the money for, and how we could be partners. I think at the end of the day, there's money out there, but it's probably more important to pick the right partner. And so for when we sell businesses, for owners that may still have a minority share or be involved, we always say that it's not the person or the group that offered you the highest value. It's the one that has the complete package. Who's going to be the best partner for you that gives you the value that you're looking for? Because if you're going to have to still work with these people for years, they may have given you more money, but it may be just a bad partner. Your culture isn't aligned, your values aren't aligned. So money, value, valuation, culture is important. Picking your right partners are important. And to do so is really getting to know one another. And it's that time when you first meet them to get to know them, almost like you're on a first date. And then, hey, do we want to continue? Do we kind of like what we're hearing to go forward? Because I do think it's a people investment.
Awesome. And I guess kind of going off of that, looking more into that relationship, Caroline was talking about possibly hiring a firm with depth of knowledge in their industry and technology. So to prepare a valuation for that company, do you have any just high level tips on, you know, how much does it cost? How long does it take? Those kind of details like that. Anything to kind of keep in mind when you're doing your search?
Yeah, so it's going to vary widely. So I would say on your low end, you're probably in it for $5,000. And I would say that you're going to get what you pay for, generally. So I think it's great to find somebody that has an industry expertise. But what I would tell you is that I don't know that a valuation with a stamp on it that says this is an official valuation is probably what you would want, because a startup company, it's so dependent on what you're going to tell whoever is valuing it. And so what you may need is just to sit down yourself or with somebody and go through a process of modeling, kind of going through the all the assumptions and coming up with a value yourself that you can bounce off somebody. But you know, when we talk about a valuation, if you go tell a professional you want one, that has a lot of documentation required with it, and it could be more costly than what you really need to spend to get where you want to go. I don't know if that made sense.
Yeah, I think, you know, again, the importance of the valuation are the assumptions related to the projections. And so the more detailed oriented the bottoms up approach of how you came up with that is what the discussions will be about. And so, you know, some companies say, I'm going to grow at 10% a year, but they can't tell you why. So it's just kind of a made up number. But if there are specific reasons the market is growing at 50% a year, we're just going to capture a small percent of that market. We're not going to own the market. I think it lends more credibility to those assumptions. And too often we just see a 10% growth rate. And the question then is, where did that come from? And they stumble. It really ends the conversation at that point because you've lost credibility. And so, as Chris pointed, it's more having the bottoms up approach to defend your assumptions, which ultimately defend your valuation.
Wonderful. And I think we have just one moment left before I want to do some of the conclusions, but were there any questions that I skipped from anybody that you wanted to unmute and ask real quick before we continue? Okay, well, incredible. Frank, Chris, thank you so much for being with us today.